JBlog, 10th of July 2010. The market is starting out with some losses in Asia. Hong Kong and Japan are being hit by the not so great labor reports on Friday out of the United States, and Australia is being hit by an introduction of a carbon tax, which is going to make Australia less competitive in the market. Um, Going back to the um, the report, the jobs report on Friday, that was a big surprise. Wall Street certainly did not like that, and we had a big drop on on Friday, and there was lots of shock and everybody's pointing fingers at everybody else. I'm not pointing fingers at anybody because there's no recovery. It's just money printing. I mean, not money printing so much as releasing money. The Fed has been financing the US's deficit for basically for this year. Foreign nations have stopped buying US debt, so the Fed is purchasing those debts at this point and basically driving an economy that really needs a rest, that really needs to come back where it makes fundamental sense. Um, the the ECRI index, ECRI index has been dropping here. We can see here leading indicators are softening up. Um, Looking at oil futures had been dropping. Uh, Oil futures had achieved very strong divergence between the buyers and the speculators, where the speculators believed that oil would go very high, and producers and consumers took the opposite side of that. Oil has since recovered some. Going over here to the PE ratio of the S&P 500, it is once again at 2391, which of course is way too high. If we look at where is dividend, if we look at dividend yield of the S&P 500, we see that dividend yield is currently at 1.74. It is extremely low, except for the year 2000. It's never been this low. And of course, what's the point of holding stocks long term with that kind of a dividend yield? It makes more sense to hold bonds. So the market is still operating on the greater fool theory that says that somebody buys a stock with the hopes of finding a greater fool to buy it from them. Oil had dropped to the lower side of the channel and hit 91 and has been increasing since. There was the snapback rally over the last 2 weeks, which has taken a lot of people by surprise, including me. I did not think that there was a reason for the market to go up quite that dramatically. If we look at the New York Stock Exchange composite, we see this amazing rally here that happened. The market bounced right off the 200-day moving average and went straight up. All I can say to that is short covering rally. That's the only thing that makes sense. But of course, Friday's job numbers brought the enthusiasm quite a bit down again. So we'll see what happens on Monday. If we look at other indexes around the world, and I think you always have to look at everything, you can't just look at one thing. The world index has had this jump as well, not quite as high. If we look at the Asian index, uh, again it has had this jump. Then we look at the Asians without Japan, again snapback rally, and we look at the Europeans, again, a bit of a snapback rally. Friday came in as a pretty weak day here. That was fallout from the jobs report in the US. But a lot of those markets have actually bounced off of that 200-day moving average, or have once again jumped above it. So I'll have to view that quite carefully and see where that goes. So going back into the US markets, we are at the top of the stochastics, and starting to roll over here. So we could be looking at a further downside. We've broken through the RSIs, the shorter term RSI starting to turn, break the 70s, and is starting to turn down here. What else do we have? On balance, volume hasn't really shown us any new highs here. The S&P 500 index, it's almost achieved new highs. Not quite, so this could potentially be a double top right here. Until that point, it looked very much like a head and shoulders. This run up last week was just crazy. It was something that really is not justified by the fundamentals as I see them. I don't see anything that has improved in the last 2 weeks. QE2 is now done. QE3 could come. There are people who talk about QE3 being on its way, but really, what has QE2 achieved for the average Joe down on the road? I mean, it's made a lot of people quite rich, and it has provided some temporary relief to people in the upper income brackets, but it has really done nothing to the unemployment rate. The unemployment rate is still above 9 as of right now. So QE2 I would pronounce as a complete failure, except for people who own stock. Outside of that, there's nothing really. So from that point of view, I don't see a justification for QE3 to come in. But of course, Washington doesn't seem to need any justifications. New York doesn't either. And again, all the charts pretty well look the same at this point. Things were starting to roll over, and then suddenly this bounce comes in out of nowhere. So I'm not sure what caused it. Short covering, sure, but where does all of this capital suddenly come from? I don't know. Maybe the Fed is buying stocks now. I have no idea. I'm not a buyer at this point. I continue to deal with this market with distrust, and this really makes very little sense to me. So I just stand by the sidelines. I've covered some of my shorts, and I'm just waiting for the market to start making a little more sense. It doesn't right now. What else do I have? Apple, again surprising. Apple is almost up to new highs. It was showing a very clean decline here, and then suddenly breaks through again. What's the justification for that? I have no idea. Fundamentally, nothing has changed. Sure, maybe there's a new iPod, a new iPad, or a new iPhone coming out, but really. And there's quite a lot of stocks that look this way. Let's just go through the core sectors and see where the strength is and where the weakness is. So the S&P 500 itself, of course, almost, not quite, but almost to new highs. Friday again was a down day due to the jobs data. Materials, again, very strong on the material side. Energies a little bit lower, so definitely we are still in a downtrend here, even though we had this bounce up, but we're still in a bit of a downtrend. We're just at the highs established here, but we still have a few highs to take out over there. Financials are, as before, in pretty rough shape. They are nowhere close to the highs set in back in March. So financials still in trouble, and of course they're dependent on Greece and Italy and Portugal and all the other nations that are over there. And there's a significant amount of banking exposure in the United States to the European banks that have lent those states money that they will never recover. Industrials, again at almost new highs, so industrials are strong. Technology, same thing. Um, Again, almost at new highs. Consumer staples, now this one doesn't make sense because that's a sector, a defensive sector that would be strong in this time at this point in the cycle. Utilities has made a new high, so utilities are strong, and healthcare almost made new highs. And then finally, consumer discretionary. Again, this one doesn't make so much sense to me because I'm thinking that without the jobs, consumers should really have not have that much spending power. But they seem to be buying lots of iPods and iPads still, so it can't really be that bad. Unemployment insurance seem to continue flowing, and of course the future taxpayers are paying for that. So we'll see where that goes. That's about all I have. So once again, looking at the sectors, defensive sectors are stronger than growth sectors, and if it wasn't for this snapback rally, which may or may not hold, we'll have to see. We'll have to find out where its strength actually lies, where all this money comes from. Um, if it wasn't for the snapback rally, we would definitely be in a confirmed bear market at this point, and fundamentally we should be in a bear market at this point, but we'll see where that goes. So that's all the update I have. And well, all the best, good luck, and I'll talk to you in the future.